Hi, this is Brian with your Q4 2023 update. And remember, at Leelyn Smith, we try to reach client goals with the least amount of risk possible. Okay, well, the stock market is known in the short term to be kind of crazy, to be reacting to irrelevant news items, but over the long term, to make sense as true factors emerge. The bond market is a little bit different in that it is generally more deliberate and less volatile than the stock market. It's a bit more unified. And the bond market tends to have a unified opinion, and that opinion right now is speaking volumes. So we'll cover this dynamic, what that opinion is and how that impacts our outlook. So we'll start with some definitions first. First, the difference between stocks and bonds. A bond, the fundamental difference between the two. A bond is a loan, whereas stock is ownership. So an investor has the option of being a lender or an owner. Being a lender is generally less risky because if the company were to fail and go into bankruptcy, that company needs to pay back its loans, and a bond being a loan would get paid back. Not so with stock. Stock is, you're an owner, you take the risk out of the company failing, and if it fails, your investment goes down with it. By the way, that's why stocks over the long term, or at least partly why stocks over the long term have returned more than bonds, because you're getting compensated more for the risk that you're taking on. Now, the dynamic between a bond issuer and the bond investors is where this gets interesting. Bonds, being a loan, inherently pay interest to investors to tie up their money. And as bond prices go down, that relative rate of the bond goes up, and vice versa. So the investor has a little bit of leverage on the issuer if they're able to buy up a lot of bonds. And of course, if there's more supply than demand for that bond, that would also push the price down. The bond investor could sell those bonds and put downward pressure on the bond price, thereby pushing up the rate. So what's the bond market saying right now? Well, the US government issues government bonds called treasuries. And US treasuries are considered the safest investment in the world, largely because of the quality of the United States economy. So you have large investors like pensions, large corporations, even foreign governments buying and selling our treasuries, but generally buying our treasuries. These large investors, as of late, have begun selling our treasuries in more amounts, thereby pushing the price of treasuries down and increasing the rate paid relative on those bonds. Meanwhile, the Federal Reserve is also selling treasuries as part of their quantitative tightening program. So this dynamic of large investors selling bonds and the Federal Reserve basically doing the same thing is putting pressure on the US government to reduce its spending. And in August of this year, Fitch, a bond rating company, downgraded the US debt, citing unsustainable fiscal policies, basically spending and deficits by the fiscal government. In other words, the bond market is telling the US government, the issuer, to slow down your spending. So for our purposes and our outlook, the Fed is keeping interest rates higher, probably higher for longer, as Chairman Powell said, thereby making short-term bonds a little bit more attractive. Now, we know this dynamic will not last forever. So for our portfolios, we are concentrating on short-term, high-quality bonds. And we also know that this dynamic will not last forever. That means that at some point, rates have to come down or at least ease and pause, and that should ignite the next upward cycle in the business cycle, thereby leading to stronger markets. Okay, that's it for now. Keep a lookout for our next quarterly video. And remember, at Leelyn Smith, we try to reach client goals with the least amount of risk possible. Thanks for watching.